Hey guys, today I want to talk with you about dividend stocks and more specifically, the 8 key things that I want you to consider before choosing the right dividend stocks to buy. Because just simply seeing a high dividend yield is nowhere near enough information to go off, and it's a booby trap that a lot of new and enthusiastic investors can fall into. So stick around for this video because I'm going to start with the basics and I'm going to work my way up to some of the more in-depth topics. So make sure you stick around for the whole video to soak all of it in. And don't worry if you are a new investor, because even though those topics become more in depth, they are not complicated and I'll make it really simple and easy for you to follow. Just before we dive in, my name's Dan and this entire channel is devoted to helping you with your personal finances, overcoming those fears and concerns you have, and really helping you break down and understand some of these concepts that are actually really easy and not scary at all. All right, enough dilly-dally. Let's have our cake and eat it too by finding the right dividends for you. Ooh, those sweet rhymes and puns. So the first step is we go to their stock quote and check that they actually offer dividends at all. So we're looking at JP Morgan Chase & Co. And here is where we go to determine whether they offer dividends. And we can see, yes, they do. They offer $3.60 per share, which is 4.11%. So the way you work out this 4% is you take the $3.60, you divide it by the current stock price, and then times it by 100, and that's going to give you 4% or 4.11%. It's really important to understand that companies are not obligated to pay dividends at all, let alone pay specific dividends. They're completely up to their own devices, and they can change or get rid of them at any time. So don't just buy stocks assuming that they're going to pay dividends, because you might get an upsetting surprise. The next thing we need to do is look at their dividend history. We wanted to determine how well and how much they've been paying in dividends in the past, and that can help us determine how much they're going to be paying into the future. So let's go over that right now. Come over to my screen again. So if we take a look at PepsiCo, we can see that they offer a 3.07% yield, which is fairly decent. That's a really strong dividend yield. So if we want to look at their history, we come over here to the historical data, and I'm in Yahoo Finance, by the way. You click on that. We look here, we can see historical prices. We change that to dividends only, change the frequency to monthly. We change the date over here. Let's just take a random date. You can see I'm Australian. We do day, then month. So you're going to find that really weird if you're not from Australia. Let's go back to the year 2000. Click done, hit apply. So if we come down to the bottom here, we can see that they've increased their dividends consistently since the year 2000, which is exactly what we want to see when we're investing in dividends. We want consistency and we want consistent growth. And many companies will offer this and many more will not. Now, many new investors end their research here because it's about as far as their understanding goes. They look at the price, they look at the dividends, they look at the dividend history. They think they've determined enough about that particular company. But there are so many more important factors that we need to consider. So let's kick on. Next, we want to determine if a company has growth potential, and that's what we're going to touch on in the next 3 points before we start looking into the financials. But don't worry, even though it sounds complicated, it's not. I'm going to keep it super simple for any investor at any level of experience, so don't freak out. Stick around for the ride. For me personally, the growth potential of a company is the number one most important factor, because if a company is not going to grow and prosper and become sustainable and successful, then why would I invest my money in that company? Now, the first place we look to see if a company is growing is through their revenue and earnings. We want to see growth in those areas. So let's analyze that. Come over to my screen again. Here we can see JP Morgan, and if we come over here and click Max, we can see that their stock price has really consistently grown very steadily, very impressively over the years. Now that's fantastic, but if we come over here and look at their financials, we can have a look at their earnings and their revenue, and you can see that their revenue has been growing every year since 2016, in a time where many banks have really struggled. And you can see here, pretty consistent between 2016 and 2017, and then great growth to 2018, and great growth again into 2019. That is what we're looking for. We want strong price growth on their stock price and strong earnings and revenue increases. That shows me that that company is going places and heading in the right direction. Next, we want to make sure that what the company has to offer will stay relevant and necessary into the future. It is well proven that it's very difficult for companies to survive multiple generations because so many things change over the years. And particularly when you get into the third generation, that's when you see companies struggle the most, and it's where most of the failures come in. So picking winners that are going to stick around for the long term is super, super important. It's operation critical. And the only way to do that is to do your own private research. Look into the technologies they use. What do they offer? Will that still be relevant into the future? Because only having short-term success does not a successful company make. The next thing we need to consider, and I think it's one of the most important and most overlooked, is we want to make sure the companies we invest in and the ones we're considering investing in offer a competitive advantage, otherwise known as a moat, which is a term popularized by Warren Buffett. If a company doesn't offer something unique and something that's hard to emulate, it's very possible that other companies will slowly start to make their way into the industry, slowly take away their market cap and their market share, and sometimes even push them all the way out of the market. So we want to make sure that we invest in companies that are around for a long time because they offer something that others simply cannot, or they have a competitive advantage because they can make higher profits on the exact same things within that industry. Think about Facebook, particularly when it came out in 2006 or 7 or whenever that was. It was the only thing like it in the world. And even now, with so much social media being such a massive part of our lives, it's still really unique. There's just something about Facebook. Another great example is Apple. And Apple were fantastic at getting ahead in a market that didn't really exist before them. And what's happened now? People buy iPhones just because it is Apple. It is an identity. It is a brand that is so solidified in us that people either buy Apple or not Apple. And that's a great advantage to Apple for Apple to have. All right, now we're getting into the nitty gritty. And this is a part of the process that so many investors, and not just beginner investors, many investors fail to do. We're gonna take a look at the financials of a company. Just the basics. I don't even have the expertise to go really deep on this topic, but I definitely can give you some of the really important basic understandings. And don't freak out. I'm going to make it as simple as I possibly can. And it's really nowhere near as complicated as people think it is. So stick around. This is going to be super helpful. All right, come over to my screen again. We'll have a squiz. And for all you non-Australians out there, a squiz is have a look. Let's have a squiz. All right, so if we take a look at Coca-Cola, for example, and come across here to the financials tab, and then click balance sheet, we're just going to take a look at two very simple figures, very easy to understand, very easy to interpret. So first of all, everything you see here is times 1,000, all numbers in thousands. So for example, that's 9 billion. This is 830 billion. Okay, so this number here is the total current assets, which is effectively just cash or assets that can be turned into cash within 12 months quite easily. Now we look down here at the total current liabilities, which is debts or debt that has to be paid to creditors within 12 months. Now what's important about these two figures is if the current assets outweigh the current liabilities, then we know that the company can afford to pay off their debts within this 12-month period without relying on new sales, new revenue. Next, we want to determine what percentage and what portion of their earnings actually goes towards paying dividends to their investors, to their shareholders, and that's known as the payout ratio. Now, the payout ratio is exactly that. It is the ratio of their profits that they pay out to their shareholders, and the rest of it, the other percentage, is their retention ratio, and that's pretty self-explanatory. It's the amount that they retain in profits that they can invest in their company however they please. So for example, if a company earns $100,000 and pays $25,000 to their shareholders, their payout ratio is 25%, which means that their retention ratio is the rest, the 75%. Now, a common question that people have at this point is there a payout ratio too low? Is there a payout ratio that's too high? Or is there a Goldilocks right in the middle that is perfect? And the simple answer is yes and no, but mostly yes. Basically, what a payout ratio is showing you and why we analyze it is it's showing you how sustainable their payouts are. And if we find that figure to be really high and their payout ratio is 80, 90, 100% or even over 100%, which yes, does happen, we can determine that is probably going to be unsustainable. How are they supposed to continue to grow their business if they're paying all or more than all of their profits to their investors? We're looking for a sustainable figure, and for me, that's usually something around the 50% mark, maybe slightly below that, and I will definitely accept one slightly higher. So let's have a quick look at Coca-Cola and determine what their payout ratio is, how you can find it, how you can analyze it, all that sort of stuff. Don't worry again, it's not complicated, I promise. All right, so we're back here on Coca-Cola. As you can see, it's a different day. Sorry about that. Don't worry, it makes no difference. These figures don't fluctuate too much. First thing we do, we come over to statistics. Now we're going to scroll down a little bit and we're looking for payout ratio, which is right here. So here we can see that 28.65% of their earnings is going right back to their shareholders. And that's what we're looking for in this instance. We want to determine what percentage they are paying to their shareholders to see if that is a sustainable figure. And 28.65% is a pretty sustainable figure. That's not hurting the bank, they're pocketing plenty of their money, and that gives us the confidence we need to know that they can afford to keep paying dividends at that rate. So if we come back to Homebase here by clicking Summary, let's now move across to the Financials tab and come down here to Cash Flow. Now, if we scroll down the page a bit, we can actually see here dividends paid, and we can see a dollar figure that they are paying back to their shareholders. And not only can we see those figures, but we can compare it to other ways that they're spending their money, which can also be really important to look at. But just for now, let's look at the dividends paid, and you can see $9 billion pretty consistently is what they're paying back to their investors. Now, this gives us a really good indication of how much money they actually put into their dividends. It's very easy to look at the dividend yield and look at their dividend history and a small dollar amount, but this really shows us how many dollars literally are going into their dividend investors' pockets, their shareholders' pockets. Which brings us to our next thing to consider, and that is the PE or price to earnings ratio. And it's one of the concepts that people really struggle to wrap their heads around. So I'm going to make it freakishly simple for you right now. The PE ratio shows us how much we are willing to pay for a stock compared to the profits that that company makes. So for example, if a company has a PE ratio of 15, we are willing to pay $15 for every $1 that that company makes in earnings. Now, interpreting it is also not complicated, but it is often confused by people. There are two things and two different ways to look at a PE ratio, and it depends which side of the fence you sit on. So I'm going to lay them both out there for you. The first way is that if you see a high PE ratio, some people interpret that to mean that people are paying a high amount because they expect a lot of growth in their future. And that's a totally valid argument. But the other school of thought, which is where I come from, is when I see a really high PE ratio, to me that means that the price of the stock is overvalued. People are willing to pay too much compared to the amount that the company's earning. And by the way, the PE ratio average for the ASX 300 and also the S&P 500 is around about 15, and it's pretty consistent in that way. For the love of all things holy, if you enjoyed this video, do me a favor and like it. It means the world to me. I put so much effort into these videos, all my blood, sweat, and tears, and watching it grow just brings me so much joy. And I love helping and reach as many people as I can. And liking the videos helps YouTube really promote my video and get it out there to the wider audience, which helps it grow faster. So please, if you did enjoy it, don't forget to like the video, subscribe if you enjoyed and you want to see what I've got coming in the future. And until next time, I'm Dan, and you've been Dansplained. See ya!